Howdy, welcome to Liberty Call. Today is Friday, May 3rd, 2024. Hope you are having a fantastical day out there in the interwebs. It's a pretty nice day here in Colorado. Sun's out again, can't complain. And the cold front stalled a little bit, so it's still warm today. So get a little cooler later on today. So anyways, hope you're having a fantastical day and a good leading up to the weekend. So it looks like markets were in a better mood again today. So again, I mean, I think the jobs report came in under what everyone was hoping, so that's given some hopes to the to the markets and to traders out there that interest rate cuts are on the horizon. So again, don't get too ahead of yourselves. So, all right, well, if it is your first time watching Liberty Call, you can give me some thumbs up, like, share, subscribe, follow, and press the notification bell. Let's go ahead and get into today's numbers. All right. Dow Jones, get that off screen. Dow Jones was up 1.18%, 450 points, closed at 38,675. S&P 500 was up 1.26%, closed at 5128. NASDAQ up 1.99%, closed at 16,156. The VIX fell 8.11% today. It's at 1349. Canada up 0.57%, Brazil up 1.16%, and Mexico up 0.89%. In Europe, Germany was up 0.54%, the UK up 0.51%, France up 0.54% also, the Netherlands up 0.99%, Spain down 0.16%, Italy also down 0.32%, Switzerland up 0.56%, and Portugal down 0.25%. Let's see here. Russian exchanges both in the green today. The MOEX barely up 0.02 and the RTSI up 0.59. And the Asian markets, the Nikkei was closed. Australia up 0.55%. New Zealand up 0.56%. Chinese markets mostly closed. The Hang Seng was open. It was up 1.48%. And the Taiwan weighted up 0.53%. So that is today in the markets. Let's go ahead and bring up our weekly chart. Excuse me. And see how everything turned out for the week. Starting out with the Dow Jones. Looks like it's going to finish the week off up about 1.03%. The S&P 500, about 0.39%. The NASDAQ, 1.39%. Dow Transports, where's that? Right there. Up 1.04%. And the Dow Utilities finish off the week up. Whoa, that's a big gainer. 3.17%. So that's the big one for the week. Of the three major indexes, like I said, that looks like, what was it? The NASDAQ that was the best? Yeah, 1.35%. So, all righty. So that is the week in the market. So y'all feel better? I mean, not really me. I mean, it's still a mess out there, folks. All right, let's get over to the economic data that came out this week. Starting out with initial jobless claims came in at 208,000. Forecast was 212. Last week was also 208,000. Continuing claims came in at 1.774 million. Forecast was 1.8 million. Last week's number was also the same. Did they just copy and paste? Makes you wonder. U.S. Employment Cost Index, quarter over quarter, grew at 1.2%. Forecast was 1%. Last report was 0.9%. House prices, or the house price index year over year, grew at 7%. Previous number was a 6.5%. And if you look down here at this chart, we have not really had a contraction in home prices since the housing crisis back in starting in the end of 2007 and running through about early part of 2012. So, I mean, yeah, it has come down a lot. House increases had bottomed out at around about 2.9% last summer in July, but they've crept back up at this point. House price index month over month grew at 1.2%. The forecast was only 0.1%, so quite a bit of a miss there. The consumer confidence index came in at 97%. Forecast was 104. Previous number was 103.1. The ISM Manufacturing Purchasing Managers Index came in at a 49.2. Forecast was 50. Last month's number was a 50.3. And anything below a 50 shows contraction in whatever index you're looking at. Anything above 50 shows it's in a growth situation. U.S. all-car sales came in at 3.04 million. The previous number was 3.02 million. And we can see it's been fairly steady over the last 2 years. Certainly not as high as it was a number of years ago back in 2013, 2014, but still not terrible. U.S. trade balance, currently we have a deficit of $69.4 billion. Forecast was $69.5 billion. Previous number was 69.5 also. And again, if you look back at the historical chart, it almost got, we really haven't had a decent deficit since, the early 90s and the early 80s and 70s. So since then, it's just been huge deficit spending. All right. U.S. factory orders month over month grew at 1.6%, right on forecast. And the previous number was 1.2%. Nonfarm payrolls grew at 175,000. This is the report I was talking about. Forecast was 238,000, which again isn't exactly anything just to freak or be happy about. But coming in below forecast is what I think gave a lot of traders and those on Wall Street, that green light that, things are starting to get a little bad. Maybe the Fed will start lowering rates. Again, I don't think they're going to do anything until something gets really terrible. Let's see here. The U.S. unemployment rate grew to 3.9% from 3.8% last month. The forecast was also 3.8%. And the U.S. labor participation rate is 62.7%, same as last month. All righty, so that is all the data that came out this week. Pretty good stuff, I'd say. All right, let me get my notes up here. And let's go ahead and jump over to the market recap. U.S. stocks jump as Apple leads tech higher. Weaker jobs data stoke rate cut hopes. U.S. stocks surged on Friday, propelled by gains in the tech sector led by Apple, despite disappointing job gains in April that fueled expectations of potential interest rate cuts by the Federal Reserve. Following the release of April's Nonfarm Payrolls report, which showed a slower job growth rate of 175,000 compared to March's revised figure of 315,000, Treasury yields declined. The 10-year Treasury yield fell 6 basis points to 4.511% as investors bet on the likelihood of rate cuts later this year. The unemployment rate ticked up to 3.9% from 3.8% in March, while average hourly earnings growth slowed to 0.2% for the month. Morgan Stanley noted that the labor market was showing signs of improvement, reinforcing their expectations of 3 interest rate cuts this year in response to the data. Apple's stock soared more than 7% after the company reported second quarter results that surpassed estimates. The tech giant also announced a substantial $110 billion stock buyback program and a dividend increase. Despite iPhone sales falling slightly short of analysts' expectations, Apple's overall performance, especially in China, alleviated investor concerns about slowing growth in the region. According to Wedbush Securities, Apple's pivot into artificial intelligence could spark a new growth cycle for the company, particularly with improvements in iPhone demand and services revenue in China. In other news, payments firm Block, or Square, saw a decline in its stock price despite reporting strong first quarter earnings driven by a boost in Bitcoin-related transactions. On the other hand, biotechnology firm Amgen's shares surged 12% after expressing confidence in its experimental weight loss drug following an interim study analysis. Crypto-related stocks generally rose on the back of a Bitcoin rally, with the exception of Coinbase, which faced a slight decline despite posting better than expected quarterly results. Oppenheimer raised the price target for Coinbase, citing various positive factors that could support the stock going forward. All right, so that is the day in the markets. Let's dive a little deeper into the April employment report, and this report comes from First Trust. Robert Stein, their deputy chief economist, is the author. All right. The April labor market report fell short of expectations, showing slower job growth, wage growth, and hours worked. Non-farm payrolls increased by 175,000 below the consensus 225, and the slowest pace of the year, excluding government, education, and health services, and leisure and hospitality, sectors affected by structural factors and pandemic recovery. Core payrolls rose by a modest 67,000, also the slowest rate this year. Civilian employment, which includes small business startups, increased by 25,000, resulting in a slight uptick in the unemployment rate to 3.9%. There's a debate about whether the surge in immigration is influencing job growth, with payroll survey data suggesting stronger growth compared to civilian employment. Slower employment expansion could also signal an economic turning point towards a recession. Other indicators from the report include a 0.1% decline in total hours worked and a modest 0.2% increase in average hourly earnings, now up 3.9% from a year ago, the smallest gain since 2021. While the Federal Reserve may view slower wage growth positively, it poses challenges for workers as inflation outpaces these modest gains, eroding purchasing power. The mixed labor market data suggests the Fed may not consider rate cuts this summer, but continued softness in inflation could position them for potential cuts in the fall. Slower job growth trend raises questions about the broader economic trajectory and the impact of ongoing structural and demographic shifts on employment dynamics. All right, so there's that. And one last article here, just a little food for thought, comes from our friends over at the Mises Wire. Governments could stop inflating if they wanted, but they won't. And this comes from Daniel Lacal, is the author of this. All right, so let's dive into his article. Mr. Lacal argues that price inflation is not a coincidence, but a deliberate policy driven by governments through excessive issuance of currency. They contend that inflation is caused by governments creating more money than the private sector demands, eroding its purchasing power and transferring wealth from real wages to savings to the government. They dismiss common explanations for inflation, such as rising oil prices or corporate actions, as consequences rather than causes of currency debasement. Monopolistic corporations, in their view, cannot sustainably raise prices across the board without an increase in currency supply facilitated by government. The author asserts that governments are primary drivers of rising prices due to their control over currency issuance. They criticize modern monetary theory, or MMT, and neo-Keynesianism for advocating excessive government spending, which they believe leads to inflation and weakens the private sector. I wholeheartedly agree with that. According to the author, governments perpetuate inflation by overspending, then attempt to address it through taxation, further weakening the private sector. They argue that this cycle erodes confidence in the currency and can ultimately lead to economic instability. The solution proposed by the author is for governments to reduce spending and eliminate deficits to combat inflation. They argue against government oversight of monetary policy, advocating for a free market approach to currency and economic management. Overall, Mr. Lacal presents a critical view of the government's intervention in the economy, attributing inflationary pressures to excessive government spending and currency manipulation. They argue for fiscal discipline and market-driven solutions to maintain economic stability and preserve the value of our currency. Well, that would be nice. It'd be nice if you put the money in the bank and it's worth what you put it in there, say 5-10 years later. Or it'd be even better if prices went down and your currency actually had more buying power. That'd be excellent. But what do I know? I'm just a financial advisor. So, all righty. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. I hope everyone out there has a wonderful weekend, and I shall talk to you again next time. Adios.